Let's talk about the ETFs, because as per the recent report from S&P Indices versus the active funds India, 67.4% of the large cap schemes have actually underperformed the S&P BSE 100 index. That's the data that's suggesting you the trend we have seen in the last 10 years. And due to the rising uncertainty over the performance of the actively managed equity funds, many investors are now flocking towards the passive funds like ETFs. Now, therefore, that brings us to the big question: whether this euphoria is here to stay or it's just temporary in nature, and who should invest in ETFs and how should one pick a right ETF. And to discuss all of that in detail, we have on board Mr. Hemen Bhatia, who is the head ETF of Nippon Life India Asset Management. A very good evening, Hemen, and thank you so much for joining us today on ET Now. Firstly, let's start with the basics. To all our viewers who are not that acquainted with what exactly are ETFs, if you can just tell them what are ETFs and how do they differ from the schemes like mutual funds?
Yeah, see, ETFs are actually open-ended funds, mutual funds, which are listed on the stock exchange. So, given that they are listed on the stock exchange, they have a lot of characteristics of a stock. By that I mean that you can buy a ETF real time during market hours, just the way you buy any other stock. At the same time, you can put stop losses, you can put limit orders in an ETF. So that is for the stock part. On the other end, ETFs are open-ended funds also. So an investor can enter and exit the ETFs anytime during the life of the fund, similar to any other fund. And they are very transparent. By transparency, I mean ETF is generally designed to track a particular index. So, for example, say a Nifty 50 index, or say a banking index. So ETFs track the underlying index, hence the portfolio construction of the ETF replicates the index constituents of a particular index which it is tracking. And similar to buying any stock, for buying an ETF, investors will require a demat account. And last but not the least, generally the expense ratios of the ETFs are lower as compared to a lot of actively managed funds, because it is simply designed to track the underlying index, and there is no fund manager who is doing the stock picking or sector picking in an ETF. So this is the broad overview of the ETF, covering all the advantages. So we call it best of both worlds. It trades like a stock and operates like a mutual fund.
Well, it's something that trades like a stock, and that is something as a mutual fund, which is actually listed on the stock exchanges. But Hemant, you did mention about that most of these ETFs majorly are a replica of the underlying index, and that's why the expense ratio is also lower. And that brings us to the main question, because if we see the index performance, whether you see Nifty as well as Bank Nifty, so Bank Nifty is not that away from its all-time high levels, while for Nifty, we are still shy of that 400, 500 odd points. So are the popularity is growing much in ETFs right now? Because for all of these small and mid-cap counters that did fantastically well after that bull run we saw happening post-COVID, many of these counters are still away from their all-time high levels. So is this a scenario that people are now once again shifting towards ETF?
Yeah, if you see the growth of the ETFs, two parameters I'll say. One is the size of the ETFs as per the AUM. So since 2014 till 2022, ETFs have grown multifold in terms of assets under management. And today, while we talk, the size of the overall ETF industry is close to upwards of 5 lakh crores. And second is the investor count. Here we've seen a lot of investors buying ETFs in line with the growth in the demat accounts, especially since the onset of COVID. So if I can just quote few numbers, ETFs as ETF folios, by folios I mean ETF investors as percentage of the overall demat accounts, in the industry were close to 6 to 7%, I can say, somewhere in 2020. And while we are talking today, ETF investors as percentage of the overall demat accounts in the industry, it's close to 14 to 15%. So we've seen a multifold rise in the number of investors using ETFs, and that is even reflected in the volumes basically of the ETFs. So a couple of years back, I'll say the most popular ETFs, say like a Nifty 50, used to trade on an average for a day 3 to 4 to 5 crores a day. Today, the most popular ETF and the first ETF which was launched in India based on Nifty 50, it trades close to 50 to 60 crores a day. So all the three parameters, AUM rise, rise in the number of investors, and rise in the volumes, very clearly shows that more and more investors are has now started using ETFs, and they are making ETFs as part of their overall portfolio construction.
Okay, but Hemen, now let's get some perspective from the viewer's point of view as well. So you are saying that ETFs over the years have gained a lot much of popularity when we compare it from the historical kind of a popularity levels. But what is the preferred class in terms of whether should one go as a lump sum investment in this, or is there an SIP route like we have in mutual funds is also available when it comes to the ETF world?
See, in ETFs, AMCs do not offer SIPs directly, similar to how it is offered in open-ended funds. But let me tell you, as ETFs are bought and sold through stockbrokers, all the stockbrokers who are offering stock SIP facility to the client, which is like most of the brokers are now offering, stockbrokers, all those stockbrokers can offer SIP in ETFs as well. So if you ask me, the preferred mode is always the SIP mode through stockbrokers in ETF. At the same time, investors have also become very mature. We've seen that whenever markets have tanked significantly, a lot of investors have now started ETFs on lump sum basis also, especially while you see 10, 15, 20% type of correction, which happened recently also before a couple of months. So we see a lot of investors buying lump sum when markets tanks, and depending on the risk appetite of the client can take a call whether they want to buy lump sum when markets tank or keep doing SIP over a period of time, so that the volatility over a period of time smoothens and they do not take a call on a particular price at which they enter a particular ETF.
Okay, but Hemen, in ETF world, we do track the tracking error. And I was just looking and trying to compare your like Nippon India's Nifty B's tracking error, which was the lowest when I compared from your rest of your peers. So two questions. Firstly, how crucial it is as an investor to keep a track of this tracking error, and along with that, how does Nippon India manage to keep this particular point very low, and especially at the lowest point of in number in comparison to rest of the ETFs that are available?
Sure. See, generally the perception is that all ETFs are created equal, right? So, for example, if ETF is tracking a Nifty 50 index and there are multiple ETFs tracking Nifty 50, all are same, all are equal. That's the general perception. But let me tell you, all ETFs are not created equal. While an investor is purchasing a ETF, they should do a Victor test. What does Victor mean? Now, Victor means volumes. Higher the volumes, better it is, so that investors get a fair price while they enter and exit a particular ETF. IC stands for impact cost. So impact cost is the liquidity cost or illiquidity premium which an investor pays for buying certain amount worth of ETF. So lower the impact cost, better it is. TE stands for tracking error. So as you rightly said, lower the tracking error, better it is. So investors should always look for a lower tracking error ETF. And last but not the least, the expense ratio. Lower the expense ratio, better it is. So investors should not look at any of these parameters independently. They should look all these parameters in totality, basically, rather than seeing them independently. So Victor test is a must for investor before entering the ETF. Now, specifically coming to our ETFs, Yes, over years, we have been running ETFs now since a couple of years, and we are one of the most experienced teams, investment team, who are managing the ETFs. So over the years, the experience which we've gathered helps us manage the tracking error of all our ETFs at the lowest or in a most competitive manner.
Okay, and we hope so that the lowest tracking error industry-wise continues for your particular organization. But let me ask that we have discussed and we have tried to inform our viewers what exactly ETFs are, what are the options that are available, and how do you keep a track of these ETFs before you get into one. But if someone has to like plan a portfolio of ETFs, because in ETFs also we have so many replicas of the index, what should be the strategy when it comes to having a portfolio of ETF, as well as what will be your suggestion when it comes to the fund deployment in the ETFs?
Sure. See, we generally suggest investors to construct their portfolio based on the core and satellite strategy, wherein the core can be your ETFs or say beta of the market, and satellite can be anything other than the beta of the market where the investor or advisor feels they can generate alpha. So let's take an example. Say, for example, if your core portfolio comprises of 60 to 70% of the overall portfolio weighted, 60 to 70% of your core portfolio can be divided into a broad market-based ETFs, say like a Nifty 50 ETF or Nifty Next 50 ETF, or say Mid-Cap 150 ETF. So Nifty 50 is your top 50 stocks. Nifty Next 50 is your next 50 stocks, which is your 51st to 100 stock based on the market capitalization. Mid-Cap 150 gives exposure to the complete mid-cap segment, that is your 101st to 250th stock based on the market capitalization. So collectively, Nifty 50, Next 50, and Mid-Cap 150 provides investors almost 85% exposure to the equity market cap in India, which is sufficient for any investor, I believe, to have the equity exposure, Indian equity exposure. Now coming to the core satellite part. Now satellite can be anything, right? In the core you have beta, you capture the beta of the market. In satellite you can have any stock which an investor or advisor feels can generate alpha in future, or any active funds basically which can generate alpha in future, or even AIF or even a PMS. Anything where an investor or advisor feels it can generate alpha in the future can be your satellite portion, including a lot of your sector funds, right? Even your sector funds can be part of your satellite portion. So ideally, core and satellite should work well for the investors. At the same time, a lot of investors who practice asset allocation, they use ETF because ETF acts as a very convenient tool to seek exposure of a particular asset class. So as I said to you, you can very easily buy a Nifty 50, Next 50, or a Mid-Cap 150 ETF. A single unit will provide exposure to respective index. At the same time, investors can even buy fixed income ETFs as part of their overall asset allocation. And fixed income also, today there are a lot of ETFs which are launched from target maturity funds to say constant maturity funds to money market funds, which can help investors build their fixed income part as part of the overall asset allocation. And there are gold ETFs and silver ETFs as well to provide some exposure to the commodity part of the overall asset allocation. So again, ETF is used for multi-purpose, and we always say that ETF is a very versatile instrument, can be used across strategies for different type of investors.
Okay, but for this, we'll let you go on that, Hemen. Thank you so much for joining us today on ET Now and helping our viewers understand what exactly ETFs are and what should be your strategy when it comes to investing in ETFs.